Amazon alone is worth 1 trillion. So imagine bringing over all of that liquidity onto the blockchain. It's gonna happen.
Move over, baby boomers. It's time for Gen XYZ. It's time to stop waiting on the world to change. It's time to be the change. It's time to stop thinking about how your life can be better. It's time to start taking action, massive action to improve your life. Join Zach Winter and Markadair Rios every week as we learn how others had the grit, determination, and conviction to 10x their lives, and as we explore ways that can help you 10x your life.
Hi, and welcome to another edition of the 10x For Gen XYZ Podcast. I'm Zach Winter.
And I'm Markadair Rios.
And today as our guest, we have Gven Sariol. Gven, who's known out in the crypto community as Swami Crypto, is kind of the go-to voice on DeFi, crypto, Web3, blockchain, all things crypto. He has his own educational firm called Arc Crypto Education, where he teaches investors on how to invest in cryptocurrencies to earn passive income and to help generate longer-term wealth. Gven, welcome to the show.
Hey guys, what's going on?
How you doing?
Good to have you. So I see you're out there in Costa Rica right now. We were just chatting before the show how you have kind of a lifestyle that your crypto investments, it enables you to be able to live in various parts of the world, which is fascinating.
Yeah, no, it's kind of cool. I'll get into kind of my story on how that started here in a little bit, but like I kind of follow the nomad capitalist. I don't know if you guys have ever heard of him, Andrew Henderson. And, all my life, I've really loved to travel, and I kind of have like location ADD. I can't be in one location for too long. So I ended up here in Costa Rica, which has been my home for about the last 5 months, but I'm still kind of traveling throughout the country and getting to know it a lot better. And, but yeah, I mean, crypto, DeFi specifically has enabled me to really just be free. It's not like I'm locked with some bank account somewhere. I'm able to, do my own transactions, my investments all from one place securely, and be able to pay pretty much everything that I do is paid for in crypto, which is really cool. So yeah,
that's love to hear how you got into crypto. I mean, when we were talking beforehand, you mentioned that you had run a few law firms. How did you transition over to getting into crypto and identifying that as a way to generate income?
Sure. Yeah. So I got into crypto back in 2017. And I have a slogan in our community that I say, you'll come for the gains, but you'll stay for the revolution. And that's kind of what I did. Like I started investing in 2017, and I was like, oh my gosh, I was making so much money in crypto, just investing, just trading, which was pretty much the only thing you really could do was speculate back then. And I said, I got to the end of 2017, and I was a millionaire back then. And I had about literally almost exactly $1 million. And I had invested about $40,000 that I had DCA'd over about 4 months into crypto. And that had turned into like $250,000 of it. And I was like, oh my gosh, this is really going somewhere. So what I ended up doing was I started educating people on crypto in January of 2018. I hadn't left my job just quite yet, but I was like this close. And then the bear market came, and it was like the dominoes all came crashing for me in my life. I ended up, losing pretty much my entire stash went down by 90%, just like everybody else's did back then.
What were you investing in back then? Altcoins,
it was
Ethereum, Bitcoin?
It was mostly altcoins. I was super bullish on one called EOS, which was supposed to be an Ethereum killer. And I learned my lesson to really follow the trends and also not be a tribalist when it comes to crypto. You really got to be open because the technology is always changing. And if history's shown us, like in terms of like the internet, you may have bet on AOL, and AOL is, could be the equivalent of like Ethereum and Bitcoin, right? And now, like, where's AOL? I think they've been consumed by CNN or somebody like that. But Time Warner, but they're nowhere really to be found anymore. And so, but then we had like the Amazons and the Apples and the Facebooks that kind of rose out of there. So I always keep like my finger on the pulse, and I try to figure out like what the trends are. And that's, that's kind of my philosophy, is just kind of keeping open. But my biggest holdings right now are probably Bitcoin and Ethereum. So, and that's just because they're tried and tested. And I think when Ethereum, I know they don't like us calling it that, but Ethereum 2.0 comes out, I think it's going to be really bullish for the industry, and it's going to bring those fees really down, and it may spark a little bit of a return to some nice pricing for the crypto market then.
Now, is Ethereum 2.0, is that when they're switching to a proof of stake platform?
So they've already switched to proof of stake. Well, they're going to go full proof of stake. They've already started it. Mm-hmm. But the transactions and fees is going to be much faster and much cheaper. And that's what, a lot of us who are in DeFi are waiting for, because, Ethereum's kind of become what we call a whale chain now. So unless you have like millions of dollars on it, it just isn't worth it to do it. You'd rather go to a layer 2 solution like Polygon or Optimism. I prefer to go Polygon because there's just more volume on there, and you end up making more in fees on decentralized exchanges, which we'll get into here in a little bit. But once Ethereum 2.0 launches, you're going to be able to keep all that stuff native on the Ethereum network. And I think it's going to be very, very bullish for, the second largest blockchain in the world by market cap. So,
what's interesting is you had mentioned it, kind of an analogy to the .com crash, right? And before the .com crash, it was very frothy. People were investing in all different types of internet startups, like, grocery store web van, I forgot what it was called, but, pet.com.
Pets.com.
Yeah, and they all blew up. But as you mentioned, there were a couple of survivors like Amazon and Google, and they're now among the biggest companies in the world. And we kind of went through that frothiness in 2017, 2018, and the collapse right in that bear market. And most of those altcoins didn't survive, right? Is the same thing happening right now in the bear market that we're in crypto, where you're seeing a lot of these altcoins have plummeted 90+%?
Yeah, absolutely. And I think, there's going to be a few survivors. The survivors will be the ones that are actually producing income and making profit for their users. One of them is like Uniswap. The other one is like Aave, Compound. Those all have like really, really strong use cases. They're not forks of anything else. And they make people money. And so I think the stronger the use case and the more profitable the platform is, the more likely you're going to start seeing, a lot of more people using those applications to, and moving off of banks, to be quite honest with you. Like I have 99% of my net worth is on the blockchain, and it's not in Celsius or Nexo or BlockFi. It's literally in my own wallet. And I obviously have some very, very tight security protocols, bank level, in order to make sure I protect myself. But I make way more money doing it that way than having my money just sitting there doing nothing,
Let's talk about that just for a second, just so I can understand, because I'm a little bit behind the curve on a lot of this crypto stuff. But can you, and I think that a lot of the people that are listening are as well, talk to me about the differences between crypto, trading crypto, going out into the markets and trying to find, I guess, the biggest, the greatest fool type of thing, buying at one price and seeing if somebody will buy higher. And DeFi, when you talk about DeFi, are you talking about strictly lending to other people? Are you talking about people buying tokens that are involved with financial types of businesses, and they have to use those tokens in order to, work through that system? Or how does that all kind of come together from your perspective?
Yeah. So there's different ways that DeFi can be used. So the first way is you're able to use DeFi for borrowing and lending. Let's say, for instance, that's probably one of the most notorious ways to do it. So essentially, you put your Bitcoin into a smart contract, and that smart contract, the only one who can pull that money out is you. And so like the devs or the company who has made the protocol, is what we call it, or the DApp, the decentralized application, they're not even able to pull that money out. Okay. And usually you're able to tell that they're not able to do that by highly scrutinized audits by third parties. Where when you're, so I'm also able to borrow, and like with a flash of a dime, it's so simple. I literally connect my hard wallet. I say how much I want to borrow, and boom, I'm able to put the money USDC. Let's say if I have like Bitcoin, I borrow against my Bitcoin using USDC. I have that USDC in my wallet, and now I'm able to send that USDC over to my crypto.com card, right? And it's all chewed up because I swam in the ocean with it and all this stuff. So it's a metal card, but now it looks like a ghetto card. But I'm able to transfer my USDC into that wallet account, and then I'm able to spend it. So there's
what kind of interest rates are you paying when you borrow off of your Bitcoin?
It's a variable, but typically it's about 2 to 3%. I mean, it's nominal. It's nominal. But the cool thing is some of these protocols, and especially to entice people, you're getting paid for the Bitcoin that you put up as collateral. So it's kind of a wash sometimes, or maybe it brings down your interest rate percentage. So you may be paying like 3% here, but you're earning 1% in, let's say, Aave token. So it ends up being a 2% really at the end of the day, which is really cool.
There's some hedging.
Yeah.
There's some hedging. And you're still able to have it on to be the custodian of your Bitcoin if you lend it out, or does it have to go on to like a Celsius or a BlockFi or Voyager?
No. You're the custodian. You're the custodian. In fact, I can even show you guys if you want to here in a little bit. I can share my screen and show you how easy it is. I mean, it's very, very simple to do. But like that's why the really cool part about all of this is that, like, yeah, Celsius failed. BlockFi had to be just bailed out by Alameda Capital, same as Voyager. Both of those are borrowing and lending CFI, so centralized finance protocols. But DeFi did not crash. There was no, wild west borrowing and lending, and it was all in the blockchain. So it was transparent. So let's say, for instance, though, here's where you have to understand what you're doing, because in actual true DeFi, not this fake shit over here with Celsius and BlockFi, that is not DeFi. That is CFI. Mm-hmm. Still, somebody has control of your crypto. Okay. Where in DeFi, nobody has control of your crypto. It's bound by a smart contract, and you own that smart contract. So it's permissionless. So if I come in and let's say I put up my Bitcoin as collateral and I have $10,000 worth of Bitcoin and I borrow 80,000. Well, there's no margin call. There is instant liquidation if you drop below a certain point. So you've got to like really understand and keep track of your own loans.
Can you leverage it up that high, like 8-1?
You can.
Wow.
So the cool part is, if I go to Celsius, like they're not going to tell me where all their holdings are. It's not going to be transparent. Where if I'm in like Aave or Venus or Starlay, I'm able to go in and I'm literally on their interface. I can see, okay, how much do they have lent out? and which tokens do they have lent out, and how much is put up as collateral, like literally to the T, real time on the blockchain. As opposed to like Celsius, it's kind of like, well, where the heck's my money and what are you guys doing with it? And, you know, okay, they were very enticing because they gave like a 0% lending rate. But even I was like, well, honestly, who really cares? I'm paying like 1% or sometimes even making money on stuff that I was borrowing against. So I wasn't too worried about that 0%.
How do you, so as a newbie, what would I look for in a Celsius type site that I want to stay away from if I really want to do, you know, something that's more decentralized and real kind of DeFi and kind of play in that realm? You mentioned some of those other sites, and we can kind of throw those in the show notes. But I also know that most people, when they're going, they do a Google search or something, they hear about it and they veer towards Celsius because whatever, it's big, they got a lot of marketing, probably a slick website. And it's just like, okay, I'll sign up and, oh, wow, I can get 8% on my money. Great. Boom. You know, and they're done.
Yeah. Well, so, even like 30%, I've seen.
Sure. So is that like a red flag? Like if you go to one of those websites, what are we looking for that is a red flag that I can go, you know what? I don't want to deal with that. I want to do this. Is it what you talk? Go ahead.
A red flag to me is anything that I don't have control of my crypto. So I don't have control of the smart contract. And you have to be very careful because there's a lot of DeFi out there that they say you have control of it.
Right.
You know, they get audited and then they have an exploit. So I pretty much stick to the tried and true guys. Uniswap, version 3, Frax is another one that I'm very bullish on, for my stable coins. But I would just stay away from anything centralized. Like, here's what I tell like a lot of my students, and you know, we kind of have like almost like a crypto anonymous every other day, you know, basically, especially now because, you know, they're licking their wounds. But they also see it too, because, you know, we're doing what Celsius is doing essentially, except less degen-y. And so what we're doing is we're providing liquidity to markets, and it's not determined by APR per se. Like I wouldn't be like, oh my gosh, they're paying 30% APR. Me personally, I'm like, that's it. And I'll show you guys how this works here in a little bit. But it's based off of like, who has control of my money and how am I making that APR? If it's just based on, let's say, for instance, well, if it's somebody else managing my money, I'm not comfortable with that, period, end of story. And I wouldn't mind somebody else managing my money if it was decentralized, where I could just go in and do it with a smart contract, which we're actually launching something like that here in 30 days. It's called a managed vault. And I'll show you guys here on the screen so you kind of like get an idea of how it works. But like, I look for how am I making money? Is this possible? Right. And if it's just based on, and this is how DeFi started, right? When I first got into DeFi, was literally the month that it started, which was the summer of 2020. Essentially what they do is they create a new cryptocurrency, and through inflation, they'll pay you fees for putting up liquidity. And I'll give you examples so I can show you how that works. But paying through inflation is never a good thing. And we see that through our government, right? It creates essentially fake value. And that's what happened, you know, over the last 2 years, in my opinion, in crypto, was that there was no real value. So similar to like the internet, when you were talking about it, it was the same thing. Everybody was investing in these internet companies, and they had like socks.com and pets.com and all this crap. And while I'm sure now there's a thriving pet thing on the internet, you know, what is it? I used to get my cat food from them.
Yeah, Petco, or, you know.
No, but there's the other one.
Oh, Chewy. Chewy.
Yeah. You know, it probably wasn't ready for that, but they tried kind of doing that with crypto. And now the ones that are surviving are like the OGs, the ones that haven't been exploited and stuff like that. Am I able to share the screen?
Yeah, you are. Just real quick, I just had a question. I'll give you the con. But so if So if I go to a Celsius, I'm going to have to go into the FAQs, or I'm going to have to go into, do I have to go into the white paper to figure all of this stuff out? Or it's not going to be on the front page. Like, hey, we're managing your money. You're not going to have access to knowing where it is. And hey, we're borrowing all this money from these other markets. And we may or may not have, pulled out lines of credit from Goldman Sachs or something like that. And they could all come crashing down. Like that's not going to be on the front page, right?
No, obviously not. Well, let's say, for instance, if you go, the first question you want to ask yourself is this centralized finance? Do I have control of my keys? Okay. And there's some stuff that I don't have control of my keys, that I have some people managing some of my crypto, but it's not half of my stash. It's very, very little. But they're good ideas. And I'm like, okay, I'm willing to invest in that. And if I was in TradFi, I would have to do that anyways, right? I would have to relinquish my money to a third party in order to do something like that, unless I held like physical gold. So the first thing I would do is like, okay, are these guys actually CeFi? So are they centralized finance? For me, if it's centralized finance and it's kind of like big and commercial like that, I stay away from it.
Got it.
Just because, one, I know I can do way better on my own. Two, not your keys, not your crypto. So, what I keep in there is very, very nominal. Like the one that I do use is crypto.com. And the only thing I do use that for, and Kraken for the business, because we pay all of our team members will. But I use Kraken to onboard, and then and offboard into the traditional systems if need be. I try to really, really limit that. And then I use crypto.com personally for the same thing, for the same function. But it's just to onboard it, and then off to my wallet it goes.
So you use crypto to kind of as a transfer system to get in or out of fiat, or do you use Kraken and crypto for both?
Kraken for my business, because they're much more business friendly, and crypto doesn't allow that. And then crypto.com for my business, because it's so fluid, and you can go cross chain to many different blockchains, which I use, Binance Smart Chain. I use Matic. I use Ethereum. I use various different blockchains.
Gotcha.
But the fees are way, way cheaper doing it that way than actually going to like Ethereum first and then bridging over from there, because the gas fees are so high right now.
Right.
Well, a question about, even though you're being the custodian of your crypto, if you're entering into a smart contract and you're leveraging up to exchange or loan out your, let's say, Bitcoin for an altcoin, let's say it's 8 times leverage. Is it basically like a margin? You're taking out margin, and if the price of one or either of those drops a certain amount, they could liquidate your Bitcoin?
Yeah, kind of. So, you basically have I would consider it more like, property, like a refi. Okay. So I end up putting my Bitcoin up as collateral, or my property as collateral. Right. And I go, okay, what's my LTV, my loan to value? And you can't pull out, more than 80%, I think is the max that they'll let you do, like on Aave or Venus or Starlay, which are like the main ones that I would use if I were to borrow and lend right now, which I'm not. And then I would, and then, you end up having to pay that loan back. But if you don't want to pay it, and that's kind of the cool thing about DeFi, is it'll get added into the balance that you owe. So you don't really need to make a payment. And if you get liquidated, well, they're highly collateralized, and it's all algorithmically driven. So there's no payments. Like I did borrowing and lending for 2 years. I never not once made a payment, and I probably have borrowed $400,000 or $500,000 in the last 2 years. And in some cases,
you would get liquidated if the amount that you owe, you're adding to your principal because you're not making your interest payments. If that hit 100% of the value, then
not 100%. It's usually like 75%, and then they'll start chipping away, plus an extra interest penalty of like 10% usually.
That's kind of what they do on margin too, and on some sites, right? They chip away. They don't completely take away your position. They just chip away to get you down below the threshold, correct?
Right. Yeah, it is the only reason I don't want to like consider it like a margin, because margin, I kind of liken it to like trading, right? You're using that to trade usually, and I haven't traded traditional stocks in a while, so forgive me if I'm not portraying this correctly, but I think you can't take it outside. Like you can't actually take that as cash, correct?
I think you're right.
Okay. Yeah. So right here you can. So I'm able to take it, transfer it to my wallet. And, let's say I had millions of dollars of Bitcoin, or I have some students of mine one of them had like $8 million worth of Cardano. We put that Cardano up as collateral in DeFi. Then there's CeFi and there's DeFi for collateral or Cardano borrowing and lending. And we made sure that the ranges, the LTV wasn't anything above 25%, because we know the crypto market is wild. And that, like, when I hear some of the risk mitigation tactics that like Celsius used, I was like, are you crazy? Like, they were doing like 50, 60% L to V. And I'm going like, are you insane in crypto? And I learned very early on, because I got liquidated, and I was like, okay, I don't want to teach anybody else to do that. Because at first I was like, woo, I can take 80% out. And then it was like, the next day I came back, I'm like, wait, I thought I had more Bitcoin in there. And so
that's really, really key in all of this is decentralization is fantastic, but you really need to self-regulate. And the greed factor that we all have, we have to like learn how to control that thing inside of us. I'll call it the greed factor, but it's like we get juiced up over, oh wow, I can get 50, 60, 70. Nobody's gonna,
yeah.
And self-regulating is key.
Yeah. Well, but pain is usually the best teacher as well. So you know what I mean?
So you're self-custodying, but you enter into a smart contract to borrow on your Bitcoin. So let's say you exceed the threshold. The value of Bitcoin goes down below your threshold. So how does that work? It's automatically liquidated, even though you're self-custodying your key and you've got a cold wallet that's not hooked up to the internet. It still will automatically withdraw.
Yeah, because it's part of the smart contract. So the code is written like, if this, then that, right? It's trustless.
I get
so it's like, okay, hey, that's fine. You own this, but if you fall outside of the bounds of the contract, we get our money back, because that's part of the contract.
Interesting.
So it's just automatic.
Yeah.
There's no judgment call. It's just boom.
Yeah.
Interesting.
So Zach, like you're a lawyer, like this is going to change, law going now. There's certain things that it's not going to change. Like you're not going to have, a personal injury contract and because you got to figure out like, pain and suffering and economic damages and or even, contract law or whatever. But it will streamline contracts. And it's kind of like, hey, this is what happened. This triggered this. There's no two ways about it. If that happened, then it really streamlines things that are, can be more trustless.
That is so antithetical to the law. I'm going to tell you right now, because
I know
most lawyers will tell you law is like, it's what do they call it? A term of art. Is that something that they say and lawyers say? Yeah, it's a term of art, meaning, you can have a perspective on laws that, can shift every once in a while too.
Well, I used to work for a lawyer, and he would tell me when we would sign the release, he'd be like, this is just the beginning of the negotiation. I'm like, you just signed a contract, and I'm just like, what a dick, like,
yeah, I mean, that's so true. Right.
Yeah. So
Ben,
where
have you
here
taken a look at some of the proposed legislation, the federal legislation to try to regulate crypto, and to what extent is it addressing, these smart contracts and issues like Celsius and BlockFi and Voyager are having with liquidity crises?
Well, I think those are the ones that are going to be really the ones that are going to suffer from this. You're probably not going to see it in DeFi just quite yet, because they don't understand it at all. And it's weird for me because like I'm in it every day, and sometimes I'm just like talking about DeFi, and people are like, what the heck did this guy just say? And trust me, senators and legislators, I mean, they don't know their head from their ass to begin with. So much like getting into the weeds about crypto. There's very few like Cynthia Loomis who kind of understands
That's the danger though, right? That's the danger. When they don't understand, then they start making very sweeping laws that try to cover everything, right? That are unfair to one side or the other, because they're like.
But here's the problem: is that if the United States isn't dumb, and especially with all the stuff that's going on with like China and Russia now, I don't know if you guys saw this yesterday, but I forget what the acronym is, but it's like FLING or something like that, or something like Russia, China, India, and Brazil, Bleach or something. I can't remember anyways, they're meeting and they're proposing basically putting together a commodity based currency. And you bet your ass it's going to be a crypto. Obviously it better be, because I mean, who trusts paper money anymore when it's not transparent, and it better be transparent, because I'm not sure if I trust, China and Russia and India with telling me that they're exactly what they're holding either. But yeah, like getting back to the legislation, like it's going to be very hard for them to do it for DeFi, because it's like, okay, you can't go to this website and plug in your wallet. The only thing that I could probably see happen, which it would be so cost ineffective that nobody would sign up for it, would be like, well, if you deal in DeFi, then we're going to ban your wallet from the on-ramps and the off-ramps like crypto.com or something like that. And there's no whispers of that even, but that's the only thing that I could think of that they could do to do that. So it's kind of like, a lot of these companies anyways are outside of the United States. So and if you're dealing in DeFi, it's kind of like, how do you regulate that? I don't know. I can't really think of a way.
It's exactly what you're talking about. It has to be those connectors to, let's call it in real life, or you know what I mean? It has to be those connectors to the system, the ins and outs of those systems. And because all of us at some point, we have to deal, unless we're completely off the grid, we have to deal with some sort of transition of, if we're all in crypto, we have to convert that to fiat, because not everybody's on board with what we're doing. You have internet service. You have to transfer some of that money into Costa Rican pesos at some point in order to pay your bills out there. You know what I mean? And those can be those points where they can get you.
Yeah, they can squeeze them. What I do think and they're not even there yet. They're not even close to here yet. But what I do think that we'll have is kind of like a DeFi, but it'll be like you'll have different venues within different jurisdictions. So you may have like the United States DeFi, right? So now you've got to register your wallet. Now you've got a direct link to the central bank. But you're able to provide liquidity on like JP Morgan Chase. Like right now, JP Morgan Chase is talking about this. So they want to bring the stock market, commodities, and various different things, real estate, transactions onto DeFi, onto their own network of DeFi. And they better, because banking, I mean, I don't know if you guys have seen how many banks like locations have closed. Banking is going to be extinct. And especially when you learn what I've learned, there's no need for a bank anymore. I mean, all I need is, again, the onboard and the offboard. That's it.
Banks are so inefficient. The whole brick and mortar concept of a bank. I went to a Wells Fargo a few weeks ago, and I walk in and it's got like the whole bottom floor of an office tower, and a big row of teller windows with one teller, and a whole floor of desks for private bankers, and there's one guy working among.
Where was that? Is that the Newport one?
No, it's on Ventura Boulevard.
Oh, okay, Ventura Boulevard.
Yeah, in Encino.
Encino, yeah.
Yeah,
that's all of them though.
That's all of them. That's all. The guy's been there for decades. So I was asking him, how's it been transitioning? How did you guys end up with just having a few people? And the internet was a big hit to them, but over time they've just been shrinking and shrinking and shrinking as technology shifts. I mean, you can do all your banking on the internet.
Yeah.
And now with crypto, that's just going to push it even more.
Well, on the other side, I mean, really, just in terms of, you guys might be talking about the brick and mortar stuff, but just banks in general, at least for me, the two things that are the biggest are people use banks because, like all of us, that 125,000, that 250,000, FDIC is really, really important to most of the country. So that's the first thing. So because it is protected.
But you have internet banks where they have that FDIC.
Sure. So, but it's still a bank.
And
it's still a bank.
I have DeFi protocols that now I can insure my stack as well.
Okay.
And to be quite honest with you, I probably trust those more than I trust the FDIC. Because I mean, imagine that tomorrow there's the United States dollar breaks. How are they going to there's a bank run or something? How are they going to insure
dollars? They printed trillions of dollars in order to get everybody's 401ks up and save people from COVID. So I don't think they'd have an issue like if we really had something like that.
Inflation was at what, 1%
Sure.
Now we're in a whole heap of different shit.
Absolutely.
And so imagine if they had to do that at inflation being at, I don't know, what was the last time? 8.6%. We're talking like Germany like after World War I status, if they were to have to do that.
We were just talking about that, MMT, modern monetary theory, doesn't really care about printing money regardless. And there's a lot of people that kind of feel that way. But on the other side too, banks just in general, it's not that they need the deposits, but because they're hooked into the system, the Fed, those deposits allow them to lend out 10 times the amount of what they're holding in reserves or even more. And that's the key.
That's true. But there's a huge inefficiency with the whole brick and mortar component.
Absolutely. I agree with you 100%.
Like JP Morgan Chase went on this huge, after the crash, right? There were a few, like Washington Mutual and some others got merged into Chase. And so all of those locations turned into Chase locations. And then like 10 years ago, we started seeing all these new Chase locations pop up throughout Los Angeles.
Yeah.
And if you think about that overhead, right, you've got to put people in there, you've got to pay all of the leasing costs, the property tax costs, or if you own the property, it's crazy. It's hugely inefficient.
Actually, I have a relative, my brother who worked for Chase. He was in mortgages, but he talked about that, it came out of I think you might have mentioned this, but it came out of the crash and they thought that there was going to be just a big influx of people doing personal banking. And they were trying to do that community kind of neighborhood banking thing. But now we're realizing that nobody really, especially coming out of COVID, nobody's leaving their houses. I don't want to go to a branch, I don't even need cash.
Come on. Like I was like, it was so horribly inefficient. Like I had to literally take my deposits to the bank and they finally came up with like these scanners where you had to like scan them, but then there's still like a limit and all this stuff. I'm just like, this is so inefficient. I remember last year in January, even I had to, I was buying some stocks and I was at this point in time, I was like full blown DeFi. So I was really starting to see the benefits of all of this. And I had to transfer some money, wire transfer. And it was like setting up the account and all this, where like here with DeFi, I plug in my hard wallet and I end up connecting it to the website and boom, I'm up and running, and I'm trading, and I'm, borrowing and lending and all this stuff. And I call them up. It takes me like 3 or 4 days and like hard work to do this. And I'm talking to the guy on the phone, and I go, listen, man, I'm going to give you some life-changing advice. And I said, you need to quit your job and you need to go full-time crypto, because your industry is about to get completely annihilated. Everything is going to go onto the blockchain. What I just spent doing in 4 days, I can do in less than 4 seconds on the blockchain. And he probably didn't listen to me, but I was like, he's probably going to look back like 10 years from now. He's like, dude, I should have listened to that guy.
Right.
Well, okay. So that brings up a bigger point too, man. And we'll try to get to the screen share. We might have to do a follow-up, session of this so we can even dive deeper, because it's just fascinating. But you have it looks like you have an academy, or you have like a teaching program on your website. It's arccrypto.io, and we'll put that in the show notes too. So somebody like me, I don't have a lot of holdings, and I have a little bit of Bitcoin, been kind of getting into some Bitcoin mining, which I really kind of like because there's a real estate element to it and it kind of suits my speed. I've gotten burned by trading. I was caught up in that whole 2017 ICO thing when I was like thinking I'm going to, get some kind of coin. It's going to turn into this huge company, and it was all just crap. So guy like me, I have, I don't know, let's just say I have $100,000 in the bank and I want to do what you're talking about, create my own personal bank. Where do I start? What am I doing right now that can get me started quickly? And $100,000 is not a lot of money, but for most people, that's a lot of money. So let's just start there, and maybe we can think smaller if you want to.
Okay, so let me explain the second thing in DeFi first, because it's really, really relevant to your question here. Mm-hmm. And this is where we really stand out, and what the majority of our program is based around. And that is providing liquidity, okay, so that people can trade peer-to-peer. So what does that look like? So let's talk a little bit about like the NASDAQ, right? So the NASDAQ, when you end up going to the NASDAQ or, the banks that they deal with are the ones who are providing liquidity. So they provide, and liquidity there is Apple, let's say Apple stock and the dollars, so that enough dollars so that I can trade in and out of Apple. And that's why, we often say the stock market is highly liquid. Mm-hmm. So every time though, I trade in and out of Apple stock, okay, the NASDAQ charges a fee. Now, the majority of us don't pay those anymore because the funds have gotten in, and they're like, oh, we'll pay your fees for you in exchange for your data on what you're trading and what you're buying, so that they can essentially either bet with you or against you.
I heard about that.
Depending on the trend.
Yes.
You're
right.
Right? Like
Robinhood, even TD Ameritrade, what's the one that the Twitter guy has?
That's a big thing. Not to get off on a side tangent, but that's a big thing when you're Fidelity is, they could be
selling
shorting
data,
or shorting your positions too. You know what I mean? Like seeing all that data and going, oh, look at the trends are going this way. Let's go ahead and place a bet for or against, what's going on too, and making massive amounts of money on proprietary data. Go ahead.
100%. And the cool thing, like, we don't get access to all that data because that's on the back end. In crypto we do, because it's all in the blockchain. Mm-hmm. So that's really, really cool. But so anyways, so every time a trade is made though, you bet your ass the NASDAQ is going to charge a fee. Okay. And depending on the volume of the trade, it could be anywhere between $10 and $150 on average. Okay. But if irrespective, a fee is charged, and the banks make a tremendous amount of money. Now, who else does this? Coinbase does this. Binance does this. Crypto.com does not do it. They actually don't charge any fees, but Kraken does it. So all these centralized exchanges, they do it, and they make tons and tons and tons of money. So what we have now are called decentralized exchanges, okay, where like Kraken or Binance or one of these centralized exchanges, they had to get a big infusion of capital in order to become liquid, right? So they're either backed up by a bank or Celsius or BlockFi or something like this, right? Well, with DeFi, you, me, the guy in India, the guy in Costa Rica, the guy anywhere in the world or gal in the world can put in a small amount of money into a pool, into a smart contract. And any trade that is made, you're going to get your pro rata share of what you put into that pool in terms of the fees. So like the fees to trade on a decentralized exchange can be anywhere between, 0.3% all the way up to 1%. Okay. Depending on how much liquidity is in there, how rare is the coin that you're looking to get into? Is it a highly liquid coin or is it very, low liquidity? And so what we teach you is how to become the JP Morgan, the NASDAQ, Coinbase, the people who back them by putting money into what are called liquidity pools, which are smart contracts. Okay. And you're able to gain the fees that are being traded. And, and I'm able to take my dividends out on a secondly basis, meaning it's just accessible to me right then and there.
Interesting. I love that.
Yeah.
I'm having trouble tracking how this works conceptually. So let's take like a single transaction. Like I'm on a decentralized exchange and I want to use my whatever US dollars or Bitcoin to buy another crypto. And I know I'm going to have to pay a fee. I'm not understanding how pulling together your group into a smart contract with a bunch of money in whatever crypto facilitates that transaction.
This is where I'd like to share my screen because I can literally show you much easier.
You have access. Just know that we have a podcast just as a side note. So just describe what you're showing us.
100%. Okay. So let's see here. So here's this is what's called a Uniswap v3 calculator. But what I'm able to do here is I'm able to provide liquidity. So remember in the NASDAQ description that I told you, Apple and cash, right? And I'm able to trade between those two. Well, in this particular liquidity pool, I would be going in with USDC and Ethereum. Okay, so think of Ethereum as Apple and USDC as cash. Mm-hmm. And every single time somebody makes a trade between Ethereum and USDC, I'm able to make a fee. And so much so, the way I have this particular liquidity pool set up, I'm making 512% per year. And this is what we call consolidated liquidity. Now, this is some really high level DeFi stuff. This is not, Ponzi. This is literally cash flowing from providing liquidity on people who are willing to pay.
That's why I like that.
Yeah.
Do you get to choose so I see that polygon on the top of there. Do you get to choose which
blockchain?
Yeah, which blockchain it's going to. So you're going in and you're saying, okay, tag it to USDC and Ethereum and anything that trades on Polygon or anything that trades in. Is that how that works?
Kind of. So anything that trades on Uniswap version 3, mm-hmm. Okay, on the Polygon network. Mm-hmm. I can also do Ethereum, but the fees are just way too much with how much volume I'm personally doing. Mm-hmm. And I'm able to make just as much in fees here than I am on the Ethereum side, except less the gas fees.
I'm still not tracking how, like, if there's someone with dollars, let's say John has dollars and he wants to buy Ethereum from Mary, and they're using this website, this
decentralized exchange
to do it. Why do they need someone with a bunch of money to get involved as the intermediary? And why are they giving them some of some of the proceeds? I guess there's a commission that one or both of them are paying.
Yeah. So go ahead.
No, I was just gonna, if I can interject, and I don't know diddly squat, but just from what I understand, maybe it'll help. So I think you were saying that on some of the other platforms, in order for those platforms to kind of work, they have to get loans from the big banks, the JP Morgans,
correct,
these other banks, in order to provide the liquidity to pay those fees as like an intermediary, correct?
Well, no, not to pay the fees, to earn the fees.
To earn the fees, but they provide the liquidity in order to keep everything moving.
Right. And who's the beneficiary of that? Well, it's the centralized exchange and the banks that provide the liquidity.
Yes.
Right.
So in this situation, because it's decentralized, there is no JP Morgan to provide that. And so people like you and me are able to do that through something like Uniswap.
Correct.
Are these leverage transactions? I'm still trying to understand why there's a need for liquidity. If John has money and he's buying the Ethereum and Mary has the Ethereum, where's the lack of?
Yeah. So, okay. I get what you're saying. So why? Okay. So John already has the Ethereum, then he's not going to become a customer of Uniswap. Right. But if John's like, oh my gosh, there's a dump happening, I need to hedge against this, and I've got all of this on my hard wallet. Using my hard wallet, I can execute a trade into USDC, and I don't have to take it all the way to a centralized exchange, waiting for that transfer to happen. Sometimes it can take up to, 3-4 hours. And by then I'm already wrecked. Okay. So, yeah. So
the liquidity is like a speed thing. It helps people execute their trades very quickly. In the meantime,
and get into cryptos that they don't have access to outside of, the ones that Big Brother United States allows us to buy.
So this is like a decentralized, smaller exchange. Smaller.
Not smaller. This has more volume than Coinbase does.
This has more volume. Interesting.
Yes.
But this isn't the exchange. This is actually Uniswap isn't the exchange, correct? Uniswap is the liquidity pool collector.
Well,
correct.
No, it's the exchange as well. So let's say, for instance, and I'll show you. So this is just the calculator. I wanted to bring
this is all really good because I feel like I can kind of understand it, and I actually kind of like it because the risk is taken away because you're not trading yourself. You're getting in on the transaction.
Exactly. And that's where I came up with another little slogan. I'm full of them. But where I don't speculate, I accumulate. So I'm accumulating more in Ethereum. I'm accumulating more in Bitcoin because I am getting paid in Bitcoin and in Ethereum. And I'll show you how that works. I'll actually show you here an actual thing. But so here, this is what the decentralized exchange looks like. So if I want to just swap Ethereum for USDC, I come here and I just put, okay, I want to sell 0.1 of my Ethereum, and then it automatically calculates what the market is. So it's almost like a instant market order. There's no limit orders on this. Mm-hmm. I hit swap, boom, done. And what it does is it goes from my hard wallet out to the smart contract to the liquidity pool back to the smart contract back into my wallet. So I end up with that USDC as opposed to my Ethereum.
And it's the smart and the smart pool that's taking a fraction of that amount as the fee. And Correct. That's how you're making your, I see.
So I Correct. See that $5.98 right down there. Oh, you getting a portion of that $5.98?
Yeah, I mean,
of that gas fee,
a very small portion because obviously there's hundreds of millions of dollars in that liquidity pool. But here, I'll give you an example here. I have this one here. So this is just in the last couple of days. I put up about 28,800 in liquidity. So you have to learn how to structure this because you can lose money, okay, if you don't know how to structure it correctly. But basically, in the last day and a half, off $28,800, I've earned $456 essentially. Of which,
in 2 days.
I hit collect fees in a little under 2 days. I collect fees. This is what my smart contract looks like. So I sign my smart contract. And once I do that, I don't have my hard wallet here on hand, but then these fees go into my wallet. And what did I get paid in? I got paid in USDC and I got paid in Bitcoin.
Wow.
So talk to us
and
a
now
little bit about
what I can do is
go ahead, Ken.
no, now what I can do is I can either transfer this into my, my crypto.com wallet. I can reinvest it. I can do whatever I want with it. Now, let me give you just real quick, big picture before you say this. Now, imagine that JP Morgan goes, hey, we're actually better off opening this up, doing decentralized, taking a little slice off every single transaction. Let's do this for the stock market. Let's do this for commodities. And that's what they're going to be doing in the next 2 years. So this is game-changing, bigger than Amazon type stuff, in my opinion.
So the upshot is we don't have to only think of DeFi as being either smart contracts like, hey, we're going to turn, real estate transaction and tokenize all that and, and all of that stuff. Or it's not only loans, but we really should be thinking about this type of stuff where, being able to create smaller smart contracts for these fee transactions, things like that is kind of where a lot of the money is, because money is moving around all the time. And out in the bigger centralized world, people are making money hand over fist over those transactions. And this is, the decentralized version of that we should be looking at. Correct. But we have to learn how to do it right.
You have to learn how to do it right. But this is the new Wall Street, guys. I'm not kidding you. This is the new Wall Street. And, let me show you, like, on the Ethereum side, how much liquidity in this. This isn't Mickey Mouse money. And by the way, it's raining like cats and dogs over here, so don't be afraid.
Is it the rainy season there right now?
Again, I'm in the jungle. It is the rainy season. So check this out. Total value locked, which is TVL, $3.5 billion. And we're down. I mean, I've seen this probably as high as 10 billion.
What is this now? What TVL
total
is?
Value locked. So total value locked in the liquidity pools is $3.5 billion right now.
So there's big players playing in these pools too. So
yeah, okay. There is huge, just here in USDC coin, there's $659 million. And there's I would probably say big players, probably close to 50, 60 big decentralized players who have maybe, I don't know, I don't want to say a billion, but hundreds of millions of dollars at minimum.
Wait, so I'm looking at the chart here, USDC, and guys, this is on uniswap.org. I believe you have to become a member to see this chart we're seeing. Is that correct?
No. This is Web3. So Web3 means you've got to connect your wallet. Gotcha. And that's how we sign in with things. That's where identity and all this stuff is going to be Web3. We're going to have the ability to just go, instead of signing in through our Facebook or our Google accounts, we're going to sign in through our wallet.
Oh, dude, you just started a whole nother podcast.
Hey, this is Gven. Hey, this is Mark.
So
I'm sorry.
No, I was just going to say you just started a whole nother podcast for us. But so just as I'm looking at this chart, the TVL, you have 1.08 billion in USDC, and the volume is 659 million. So basically, the transactions that are happening in the last 25 hours are 659 out of that 1 billion is being exchanged. So there's plenty of liquidity basically out there for them to transact, correct?
Oh yeah.
Yeah.
100%.
So what are the, talk to us
and I just took it off because my internet's starting to get slow because of the rain.
Oh, okay. So real quick, just go over the risks and how you could lose money in trying to act as kind of this intermediary providing the liquidity to do these exchange transactions.
There's something called impermanent loss. okay, which is a very serious risk. And if you don't know what you're doing, you could get absolutely wiped out, like I have. I often say, for those of you religious people out there, that my portfolio is the Jesus Christ of portfolio, and it has died and risen more times than I can count, and it died for everybody's sins. So, but so I've been wrecked every single way that you can think of, because I don't hold back. I go in things head first. I want to break them. I want to lose money. I want to make money. I want to learn, what the risks are. So impermanent loss is a real thing. So impermanent loss means, let's say, for instance, if I end up getting into the USDC ETH pool, right? And I'm holding, and before Uni V3, what you would do is you would actually split the stack of Ethereum 50-50. So you would have 50% in Ethereum, 50% in USDC. Now with Uni V3, you can actually proportion it differently. And that can be very dangerous, but very lucrative at the same time, if you know what you're doing. But let's keep it the old way, because it's much easier. So if I were to put 50-50 in there, that means I would have, let's say I had $10,000. I had to put in $5,000 worth of ETH and $5,000 worth of USDC. And let's say I have a price divergence, like my ETH goes through the roof. Well, that means what ends up happening is people are selling out of USDC to get into ETH. But I've put up the liquidity. So when they're doing that, they're eating into my ETH, and I'm gaining more USDC plus the fees that I'm earning and less Ethereum. So if my Ethereum is going through the roof, I'm like, whoa, I would have been better off holding my Ethereum, right? I see it almost like your dollar cost averaging out of Ethereum and taking profit plus making fees. Okay. But some people don't see it like that. The opposite is, and I've had this happen to me. Let's say you have Ethereum and Tomato Coin. Okay. And let's say bad news comes out for Tomato Coin. They get exploited or whatever happens. Something bad happens. Okay. And at that same time, ETH 2.0 comes out. So really bullish news for Ethereum. Everybody starts piling into Ethereum. Everybody starts selling Tomato Coin. Well, as that's happening, they're selling into Tomato Coin. Okay. And let's say, and this has happened to me before, they sell into Tomato Coin. My Tomato Coin, I'm holding a ton of Tomato Coin, no more Ethereum anymore. And my Tomato Coin is worthless. Okay. So you have to really be careful as to what pairs you get into. Okay. Because I like, for me, I always get into very highly correlated pairs, Bitcoin and Ethereum, Aave and Ethereum. So cryptos that move together in unison, pretty much. Sometimes they go out of range, but that keeps you really making fees all the time. And it's really lucrative when the bull market comes back. Right now, we're just hanging in there because we're just making the fees. But once everything goes up, like one of my favorite pairs to do. So instead of Apple and Cash, I like doing Bitcoin and Ethereum because I think those are the two strongest ones. So if I do that, they're highly correlated. They go up in value together. Well, now I've not only increased the value of my Bitcoin and Ethereum, but I have more Ethereum and more Bitcoin in my wallet. And that's the power of all of this stuff. And this is the way banks make money. This is not something new. We just built a better mousetrap in DeFi. I don't know if I explained that correctly, guys.
Yeah, I feel like I think I wasn't conceptualizing that you had to buy both ends of the trade.
Yeah.
That helps a lot.
Yeah.
Man, this is all fascinating. And so just talk to us just real quickly about what you teach. And I think that's probably because all of this stuff is, I'm sure, new to a lot of people. And, it'd be helpful if there was like a ready place that they could go to maybe even learn this, including myself. So,
Sure.
So what do you teach on your website? What is that you guys teach? Is it a mastermind program? What is that?
I mean, it's a mastermind program, kind of. So we have like different things. So we don't like sell little videos to people. All of our stuff, because crypto is just ongoing, moving. And honestly, the strongest part about what we do is our community. Because you hear so many people, I'm getting out of crypto, where our people, they're like, no, because we actually did the research and we did the homework and we show up week after week and we talk about our losses. I'm telling you, when I say we're like a crypto anonymous group, we kind of am, because those losses can be devastating, luckily we weren't in UST, but we certainly felt the impact of like Luna and UST. I don't know if you guys know what that debacle was all about, but we certainly felt the impact because, my crypto took a huge dip. But what we do is we teach you the fundamentals. So we start with security, of DeFi, because now you're your own bank. So we don't touch anything until, we have your VPN set up. We have your antivirus set up. We have all the right protections in place, your hard wallet set up, so that you make sure that, some hacker can't just get into your MetaMask and start transferring crypto. They have to physically be at your desk, in order to do that. We teach you how to store your keys correctly. Very, very important thing. We've had, some students before in the past lose their keys before they came to us. Zach, you look like you've done that before.
No.
That was
okay,
me.
good.
That was really hard. I did
hundreds of millions of dollars being lost.
Oh, geez. Well, don't sweat it. I mean, my dad's kind of in the same boat. So he's bummed, but it is what it is. I see it as like, you guys help the ecosystem because that money's now forever lost and burned. So you can't trade it. You can't dump it on us.
That's funny.
So we teach you how to then transfer. We teach you how to exist within different blockchains, how to go cross chain. Because, like I said, for me, I like going to Polygon because the fees are much cheaper. And a lot of our students, they don't start off with $1 million. They start off with, 10,000 or 100,000. And it just makes more sense to be there so you can split things up differently and transact for fractions of a penny. And then we keep the alpha coming. So crypto is such a fast moving industry. So we have like different strategies. Like if you're like, hey, look, I need 100% passive. We got a strategy for you. I want a hybrid. I want to spend, 2-3 hours a week working on this stuff. All right, cool. We have a hybrid thing for you where you can make a little bit more. And then we have like the full kind of, I say passive, but kind of passive aggressive because you got to be on it, where you are managing your portfolio like what I'm doing. And so we have these different things, but you got to learn how to get there first, because like you guys have said, you're like, whoa, this kind of sometimes doesn't make sense. I mean, this is a whole new way of doing things, but I liken it to this. If you have a job, let's say, I don't know, you just got out of college and you become a CPA. You don't come in and you're like, okay, I'm ready to go. I'm fully educated. No, it takes time to learn your position, learn the softwares, to learn all that stuff. The same thing goes on here for crypto. And again, we're the new Wall Street. Like this is, read what BlackRock just put out. They just put out an article saying they are extremely bullish on crypto. JP Morgan Chase is going DeFi. They've invested, I think, something like $25 million into the guys who develop Ethereum. This is not going anywhere. You see B of A talking, super bullish on crypto. So you got to learn these skills. And like so many people are like, well, because I'm kind of against regulation. And here's why. What's to prevent me as a scammer? I build a site that's from wherever. Uzbekistan. Okay. I route that through a VPN and I go, hey, I've got something that's going to pay you 5% per day. And it's out there. Okay. It's out there 5% per day. And they're very smart. They will pay you 5% per day, but then 45 or 3 months or 6 months later, all of a sudden the site goes down.
Yeah, that's
cloud. But if I send you my crypto, who's going to regulate that? Nobody. You can't. It's impossible. So what I say is let's educate, not regulate. And that to me is, more important, because I think, you guys will see this as you get more into DeFi. It's extremely difficult to regulate. And I don't think they're going to let this go anywhere, because if not, they're going to let some other country catch up to them. And they may limit the cryptos you can buy on centralized exchanges and all this stuff. But at the end of the day, I think the United States is going to cave to this. They're going to go full blown crypto. And especially if they want to remain competitive in the world. China has their own cryptocurrency. I think the United States has an opportunity here to not do like a country-backed cryptocurrency, but an actual cryptocurrency that maybe is like USDC. So this could be the next Federal Reserve, okay, where it's fully audited, and the actual money transfers into the system, and you're tying the bond system to that, and all that stuff, in order to generate value. And then now we're able to transfer USDC anywhere in the world like that. No more Western Union, no more nothing. And I think it's starting to get so widely adopted that they're just going to go, all right, we've got to do something here. We got to stick with this, because this is really the future. Decentralized anything, your identity, gaming, home ownership, all of it is going to be decentralized here in the future. Some form of decentralization, maybe within parameters, but the money will move much more freely than it does now, and 24/7.
This really activates my digital Gen X side. Like as a Gen Xer, I have an analog side and I have a digital side, and this is like, all right, that's like brings me back to Atari and the wide openness of the world back then.
Yeah. No, it's exciting, you guys. Honestly, it's exciting. It's why I've dedicated my whole life to this. And you can ask anybody, like from the second I wake up to the time I go to bed, I get a little bit of meditation in, a little bit of exercise in. I go walking in the jungle. But other than that, I am glued to reading, watching videos, breaking things, figuring this stuff out, because it's the future. And we're not even close to the end. I mean, we're talking at the most, the crypto market was at $3 trillion. What is it? Like Amazon alone is worth 1 trillion. So imagine bringing over all of that liquidity onto the blockchain. It's going to happen, because you already have things called security tokens. I don't know if you guys have heard of these. They're tokens that are securitized and basically governed by the SEC. But with a cryptocurrency, I can do everything from paying dividends, which you guys saw right here, okay, on my Uniswap V3. I showed you the dividends that I was making, right? Mm-hmm. You have governance. So you have your stock holders are able to vote using governance tokens. So depending on how many UniV3 tokens you're holding, you can vote the direction of the stuff. So all these things, these are not new things, but we're reinvigorating everything. So imagine you have Meta, right? They've got a token that is tied to their stock, governance, gaming, and dividend paying. You guys, we are not even at the snowflake at the top of the iceberg.
Interesting.
When you talk about all this stuff, and it's really exciting. Really exciting.
It's great. I could sit here and talk with you forever, until your baby comes at least, and then you'll have to go. But congrats on that, by the way.
Thanks, brother. I appreciate it.
We're really running out of time, and like we said at the beginning, we love the open forum. We take it wherever it goes, and I certainly think we achieved that today. So, just tell us where people can kind of get in touch with you again, and see what you have going on, and maybe learn from you.
Yeah. I have a YouTube channel, Swami Crypto. You can go there. I'll give you guys the link to that. Also my Instagram, at Swami Crypto. Or you can also go to arcrypto.io and learn about how we do things. But the other channels will give you like a little bit more of a feel of how we do things. I often post classes that I teach and stuff like that. So you see kind of the way we teach things and the holistic approach we take to this, because it's not exact science, you know. You do have to use a little bit of thinking, but in the end, you win. And that's what we want to do. We want to be able to take the money out of the bigger banks and spread that out. And that mass adoption truly is our goal. We want to see more of that wealth distributed, and not just by the government doing it, but by people using their brains and working for it. And I think with crypto, we now have that opportunity to do that. So it's a much bigger goal that we have here than just, you know, making money and teaching people how to make money. It's really evening out the playing field if you want to.
Love it.
Now, you can't help them if they're not willing to, but if you want to, let's do this.
I love it, man.
Fantastic. Thanks so much for coming on, Ben. We really appreciate it.
Yeah, thank you so much.
Likewise, guys.
10X for Gen XYZ is hosted by Zach Winter and Markader Rios, co-founders of Prosperity CRE, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and building long-term wealth. If you like the podcast, please give us a positive rating and subscribe to be notified about future content. Also, if you'd like to learn more about our approach to real estate investing, you can download a free copy of our real estate investment book, Investing for Cash Flow and Long-Term Wealth, by clicking the link in the show notes below. Thank you and stay tuned for our upcoming episodes.